For 197 consecutive years, one company paid its investors 18% annually, not in good years, every year, through wars and invasions, through the bankruptcy of entire nations. But in 1799, the company itself collapsed. So why did the Rothschilds, the Rockefellers, and every major dynasty that followed quietly rebuild their empires on its exact blueprint? What the Dutch were solving in 1602 was not a complicated problem. It was an expensive one. A single voyage from the Spice Islands, modern Indonesia, returned profits of 400% or more. Nutmeg, cloves, and mace were, pound for pound, worth more than gold on European markets. Portugal had built an empire on this trade. Spain had built one on silver. Dutch merchants had the ships, the sailors, and the appetite. What they lacked was a structure that could carry the risk. Crossing took 2 to 3 years. Mortality among sailors ran at roughly 60%. One storm, one Portuguese warship, one outbreak of scurvy, and the entire investment was gone. No single merchant family could absorb that kind of loss repeatedly and survive. And yet, every year, new investors put their money in anyway, not because the odds had changed, because the alternative was watching someone else get rich. Between 1595 and 1601, Dutch merchants sent 65 ships to Asia. 14 never came back. The ones that returned made fortunes. The ones that did not took everything with them. Crews, cargo, capital. There was no insurance. There was no hedge. There was only the next voyage, and the hope that this one would be different. That was the problem. What the Dutch government did next was the private layer that nobody copies when they write about this story. On March 20th, 1602, the States General of the Dutch Republic issued a charter that merged 6 competing merchant groups into a single entity. They called it the Dutch East India Company, known to history as the VOC. It handed that entity a 21-year monopoly on all Dutch trade east of the Cape of Good Hope and west of the Strait of Magellan, and it raised 6.44 million guilders in startup capital from over 1,800 investors in a matter of weeks. Among those investors were craftsmen, small traders, and at least one documented school teacher. They were invited in because the new company needed capital from every available source. Whether they fully grasped what they were investing in is a question nobody at the top ever stopped to answer. For context, 6.44 million guilders was roughly equivalent to 1,000 Amsterdam canal houses. Nothing like it had been raised anywhere in Europe before. 1,800 investors who had never met each other were now, for the first time in history, shareholders in a single enterprise. But raising the capital was the easy part. What they built with it had never existed before. 3 legal innovations made the VOC different from every trading company that had come before it. None of them were accidents. Transferable shares came first. Any citizen of the Dutch Republic could buy in, and any investor could sell their stake to another buyer without dissolving the company. Every previous merchant venture required unanimous consent to change ownership. The VOC created a secondary market in its own equity. Amsterdam traders began exchanging VOC shares on a bridge over the Amstel River in 1602. By 1611, the Dutch government formalized this into the world's first official stock exchange. But the second innovation is the one that changed the mathematics of risk permanently. Limited liability. If a VOC fleet sank in 1620, investors lost what they had put in. Nothing more. Their homes, their businesses, their other assets were untouchable. Before this existed, a single failed venture could strip a family of everything it owned. Capital could now flow into high-risk ventures without threatening the personal fortunes behind it. The third innovation was the one nobody put in a textbook. Powers that belonged to states were handed to a private company. The VOC could build forts, maintain armies, negotiate treaties with foreign rulers, strike its own coins, and administer justice in its territories. A private commercial entity received the functional authority of a sovereign nation in exchange for trade monopoly protections and a share of the returns. This is the structure the Rothschilds replicated a century and a half later. When a private bank finances a government's war, it holds the debt of a sovereign, not the same as governing, but close enough to matter, and without the inconvenience of being accountable to anyone who did not have a seat at the table. A vulnerability was built into this structure from day one, and the people who designed it knew exactly what they were doing. Governance of the VOC sat with a board of 17 directors, the Heeren XVII, the Gentlemen 17, drawn from the 6 original merchant chambers, weighted by capital contribution. Amsterdam held 8 seats. The remaining 9 were split among the other 5 chambers, 17 men, accountable only to each other and to the original charter, not to the 1,800 shareholders, not to the Dutch government beyond the broadest legal requirements. They set dividend policy, controlled trade strategy, and appointed governors to overseas territories, all of it in private sessions with no obligation to explain their decisions to anyone outside the room. One of the Heeren 17 kept a diary. It survived, and historians found it in the Amsterdam City Archives in the 1930s. In 300 pages, covering 12 years of governance, he mentions the shareholders exactly twice, both times to record that complaints had been received. Neither entry describes what was done about them. 300 pages, shareholders mentioned twice, and yet they kept investing. Here's why they had no choice. When the company performed well, shareholders received dividends, sometimes in cash, sometimes in an arrangement that was presumably more convenient for the board than for anyone holding the certificates, in spices, which investors then had to sell themselves on the open market. When performance fell, payments were reduced without explanation and without appeal. Shareholders had 2 options: sell or hold. One investor, Isaac Lemaire, decided to do neither. In 1609, he organized the first known short-selling campaign in history, deliberately driving down VOC share prices to force a governance reckoning. Dutch authorities responded by making short-selling illegal the following year. Lemaire was fined and barred from trading VOC shares for 3 years. Share prices recovered, and the Heeren 17 expressed no opinion publicly, consistent with their established practice of not expressing opinions on anything publicly. That practice had served them well for 20 years. It would serve them for another 170. Lemaire lost. The structure held. But in 1672, something arrived that no short seller, no shareholder, and no court order could have prepared it for. France invaded the Dutch Republic from the south. England attacked from the sea. The Bishop of Munster pressed in from the east. 3 simultaneous military fronts against a republic that had never faced anything like it. Dutch historians named that year the Rampjaar, the disaster year. It was not an exaggeration. Amsterdam's bond market collapsed. Real estate values fell 40% in months. Merchant families who had built their positions over generations liquidated everything and fled to England, to the German states, anywhere that was not the Dutch Republic in the summer of 1672. Historians focus on the military response. The detail they skip is the one that explains the next 3 centuries. The VOC did not liquidate. The Heeren 17 did not flee. Dividends continued. Paying dividends during an invasion requires an explanation. The official one, recorded in company documents, was that the board wished to signal confidence in the company's long-term position. The unofficial one, which requires no documentation to understand, is that 11 of the 17 directors held personal stakes large enough that stopping dividends would have cost them more than the war. Whatever the reasoning, the decision was not sentimental, but architectural. Heeren 17 understood that the dividend was not primarily a financial distribution. It was a communication. A company that continues to pay through a military crisis tells the market one thing: this institution believes it will outlast what is happening right now. That belief, transmitted through an uninterrupted payment schedule, was worth more than the capital being distributed. By 1675, VOC share prices had fully recovered. Families that held through the Rampjaar held an asset that had cycled from near collapse to full recovery in 3 years. Families that sold in the summer of 1672 locked in their losses permanently. This pattern has never stopped repeating. In 1907, J.P. Morgan organized private lending from his personal library to halt a New York bank run, deliberately signaling that the panic would be contained. In 1929, the Mellon family continued acquiring positions while others liquidated. In 2008, sovereign wealth funds from Abu Dhabi and Singapore injected capital into Citigroup and Merrill Lynch at the lowest point of the collapse. Structures change. The logic does not. What each of these families understood, and what the panicking investors around them did not, was that a crisis is not the end of a system. It is a test of who built their position to outlast one. In 1907, 1929, 2008, the same logic, different names. But if this blueprint was so durable, why did the company that invented it collapse in 1799? After 197 years of operation, the VOC dissolved under the weight of corruption, bloated administration, and competition from the British East India Company, which had studied the Dutch model carefully and improved on it. Its value was never in the company itself. What it had quietly inserted into the architecture of every market that came after it was something far more durable than a charter or a trade monopoly. The legal entity dissolved, the innovations did not. The company died, but someone was watching, and they had been watching for a very long time. Nathan Rothschild applied the core VOC principle to sovereign debt starting in the 1810s. Where the VOC had received quasi-governmental powers through a charter, the Rothschilds acquired equivalent leverage through a different instrument. When a private bank finances a government's war, it holds the debt of a sovereign state, different in form, identical in function, private capital with state-level reach, protected by legal structures that governments themselves had written. The entity that holds sovereign debt does not govern, but it sits at every table where governance is decided. Rothschild governance replicated the Heeren XVII model as precisely as a family in the 1800s could manage without access to the original charter. A private board, family-controlled, no public disclosure requirements. For most of the 19th century, Rothschild brothers published no accounts at all. Clients in their bond issues knew the yield they were receiving. The strategy behind it was not their concern. No public accounts, no disclosed strategy. It had worked quietly for the Rothschilds across 8 decades. Rockefeller looked at that structure and concluded it was not nearly big enough. Standard Oil Trust, formed in 1882, used a trust structure to hold shares in multiple companies simultaneously, making the overall enterprise legally difficult to dismantle, even as individual subsidiaries faced regulatory pressure. It took the United States government 29 years and a landmark Supreme Court ruling to dismantle what Rockefeller had built on the same foundations the Heeren XVII had established in 1602. That ruling was celebrated as a victory for the American public. Rockefeller issued no statement. At that point, he was 72 years old and had been officially retired from active management for 14 years. Dissolution of his company made him, by most estimates, the wealthiest private individual in American history. Retirement had agreed with him. Rockefeller, Rothschild, Morgan, all running versions of the same system. None of them invented it, and the city where it actually started is not New York, not London, not Frankfurt, it is Amsterdam, 1602. 4 specific innovations, introduced between 1602 and 1611, are now embedded in every major financial structure in the world, not as historical curiosities, as operating mechanisms. First came the IPO, pooled capital from multiple investors, held through transferable shares. Every publicly listed company in the world operates inside this framework. Then the secondary market. Amsterdam Stock Exchange, formalized in 1611, created the mechanism for buying and selling ownership stakes independently of the underlying company's operations. It is the direct ancestor of every derivatives market, every options contract, and every exchange-traded instrument operating today. Limited liability followed, separating personal assets from corporate exposure. Without it, institutional capital does not move into risk assets at scale. With it, the entire venture capital ecosystem, the private equity industry, every leveraged buyout of the last 50 years becomes structurally possible. And last, the short sell. Isaac Le Maire's 1609 campaign was illegal and failed its immediate purpose, but it established, for the first time in documented history, that a financial instrument could be designed to profit from declining prices rather than rising ones. Every hedge fund in operation today runs a version of what Le Maire was attempting 400 years ago. Le Maire had the instrument, but not the architecture. In 1672, so did every small investor who sold. That gap has never closed. Among the VOC's original 1,800 investors were craftsmen and school teachers alongside the largest Amsterdam banking houses. access to the same certificates. The difference between merchant families that compounded capital across generations and small investors who sold in panic during 1672 was not the instrument they held, it was their understanding of the architecture behind it. That distinction between owning a financial instrument and understanding the system it was designed to serve is the same distinction that separates every dynasty that survives a collapse from every generation that does not. Finance textbooks cover the VOC as corporate history. The chapter on what its governance structure revealed about how private capital acquires sovereign-level leverage does not appear in any syllabus. It has not appeared because it is not a history lesson. It is a live operating manual. On Oude Hoogstraat in Amsterdam, the original VOC headquarters still stands. Part of it now serves as a university building. In the third quarter of 2023, sovereign wealth funds from Abu Dhabi and Norway quietly increased their treasury positions while retail investors were selling at a loss. Chartered in 1602, the system has not changed, only the names above the door. Subscribe. The Cipher has always existed. Now you know where to look.